Prior to beginning the discussion today, I must read the following disclosures. Equity investments are affected by market conditions. The intrinsic value of the stocks in which our portfolios invest may never be recognized by the broader market. The opinions expressed are current as of August 10th, 2021, but are subject to change. The information provided in this podcast does not provide information reasonably sufficient upon which to base an investment decision and should not be considered a recommendation to purchase or sell any particular security. Portfolio holdings are subject to change. The performance of any single portfolio holding is no indication of the performance of other portfolio holdings or any other strategy or fund. Comments made on any individual company or stock is not an indication that it is currently held in a portfolio, nor is it an indication that it ever will be held in a portfolio. All right, thank you all for joining us for a focused discussion on the automotive industry as part of the Gabelli podcast series. This is Terry Pope, a member of GAMCO's institutional team, and with me is Brian Sponheimer, GAMCO's senior research analyst who has been following the auto industry since joining the firm in 2008. Brian is also co-portfolio manager of the $2.2 billion Gabelli Asset Fund and the $3 billion Gabelli Dividend and Income Trust. So for the next 20 minutes, I will host a conversation with Brian on today's general automotive trends, and he will share his insights from the value investing perspective. Welcome, Brian.
Terry, it's great to be here. Thank you very much for having me.
So let's begin with electric vehicles, a very timely topic. Last week, President Biden signed an executive order calling on electric, fuel cell, and plug-in hybrid vehicles to account for 50% of new car and light truck sales by 2030, while also asking Congress for support on tax incentives and a network of charging stations. So is this what the industry needs for EV to become the standard of the auto industry?
Well, I think it's important to frame this discussion on the numbers that are really at stake here. So in a typical year, the United States sells somewhere between 15 and 17 million vehicles. And so what President Biden is speaking to is really on the order of about 8 million vehicles per year to help transform the fleet, which is about 270 million cars and trucks in the U.S. Over the next several decades. And so getting to 8 million vehicles versus where we are today, which is well below 1 million, I think is an ambitious goal. And there are several ways to get there. The first and most important is for the automakers all to make compelling vehicles that provide both a good experience for their drivers, but also a value. And we can get into the affordability of electric vehicles in the next few minutes. What largely happened before Tesla came along was that consumers were incented to purchase electric vehicles through very generous $7,500 federal incentives to buy an electric vehicle. And then when Tesla came along and with its Model S and really provided, I would say, the first electric vehicle that both was attractive from an aesthetics viewpoint and also a performance one, that really changed the game. And so we've seen this evolve with Tesla over the course of the last 7 or 8 years. But what's really exciting here now is that there are fast followers in the industry, and the amount of new platforms that are coming out, both from a small electric vehicle to the Ford F-150 Lightning, is going to provide consumers with the opportunity to purchase a vehicle that is to their liking, that suits their family, that suits their work needs. So we can get there as a country with the number of vehicles that are going to be put out that should be attractive.
So consumer acceptance, is price still impacting the current buy-in and adoption if some great cars are on the circuit?
Absolutely. We're in a bit of a unique circumstance right now because of COVID and because of what's transpired over the course of the last year as it relates to auto production, first with factories shutting down in April and May of last year, and then the chip shortage that has subsequently happened over the course of the past 5 months. So we're in a bit of a skewed environment as it relates to the price of a new car in the U.S., which is about $42,000 right now. A new electric vehicle is still, generally speaking, well above that. You can buy a Tesla Model 3 for about that, but the size of the Model 3 is really an obstacle to broader adoption by families of 2 or 3 kids, and there are plenty of those in the country. So you start getting into the $50,000 and $60,000 range for an electric vehicle because the battery costs so much for a larger electric vehicle. And yes, so price does impact adoption, and as we've also seen, tax incentives also matter as well. And so as states have in some cases rolled off their own tax incentives, Georgia being an example, electric vehicles sales have dropped precipitously in areas like that.
So then what factors could lead to lower pricing? Cheaper raw materials, quicker to make?
I think there are several avenues to make electric vehicles more affordable. One is just simply producing more of them. You gain economies of scale from a production standpoint. Two, I think as we move further along with battery technology, reducing the size of the battery makes the vehicles more affordable. So being able to up what you get out of the battery, I think is going to be another factor there as well that plays a role. And then honestly, it's the used vehicle market is going to play a role here as you start to see the purchase of electric vehicles from a used perspective, and you see the amount of consumers that are willing to purchase used. Those may become adopters of new, and this won't factor into affordability, but it will bring a new generation of potential used vehicle buyers, so that will certainly help there. But for right now, we are in a situation where the price, the cost of producing a vehicle, whether it is a internal combustion engine vehicle, a hybrid, or a battery electric vehicle, is reaching all-time highs because input costs have risen so much. So it is a considerable issue, and one that needs to really be worked through over the course of the next decade. But the battery is the number one area of cost control there.
So speaking of that, there's much talk of hydrogen fuel cell for electric vehicles. So 2 questions. One is this the same fuel used for U.S. space shuttles? Then also, what are the benefits for electric vehicles?
So it is not the pure oxygen that gets used for rockets. A fuel cell is an interesting technology, one that's been around for about 20 years, but not one that has been, to this point, been able to be used for mass production of vehicles. Toyota, in particular, has been a developer of fuel cell technology. And basically, what happens in a fuel cell electric vehicle is that, similar to a battery electric vehicle, electricity is generated to power the wheels, but the electricity is generated from hydrogen and oxygen. The exhaust is nothing but water, and so the principle here is that hydrogen comes in one side of the fuel cell, air in the other. When the hydrogen passes through the fuel cell, and it induces a positive and negative charge that generates electrical current. It then meets the air and produces the water that comes out, and so it is theoretically a very clean technology. It is one that hydrogen is first of all, it's prevalent and it's cheap, but you can also refuel a vehicle that has a hydrogen tank considerably faster than you can through fast charging of an electric vehicle. And we can go back and talk about EVs. Charging is a major sticking point as well there. So that all sounds great. The problem is fuel cell vehicles are incredibly expensive to develop right now. Also, because the consumer adoption, at least the thought process of having a hydrogen bomb in the back of your car is something that's going to be an issue for consumers. Not that would be an actual hypothetical catastrophe that would occur, but everyone has seen the picture of the Hindenburg, and that will be in people's minds before producing a vehicle. The storage of hydrogen is also expensive. you need liquid, you need certain cooling mechanisms that would need to be installed versus just having an AC/DC fast charger for an electric vehicle. So it is a promising technology, one that could really have some major benefits for the commercial trucking market, and one that we're watching as investors for sure.
So you spoke earlier about used cars, used electric vehicles. What changes are you seeing for dealers and aftermarket retailers as EVs become a larger part of the vehicle park in the U.S.?
So this is going to be a really interesting next decade for the industry. Dealers are typically the first line of offense and defense for their partner manufacturers. And what we're seeing is that in some cases, dealers are starting to change over portions of their showrooms specifically for electric vehicles that are coming. I think the more important thing and the more costly thing for these dealers is that they need to figure out ways to service those vehicles. And that has been a major sticking point for Tesla, which does not have any franchise dealers and has some centralized service capabilities that have, to this point, largely been a bit of an Achilles heel for it from an organizational standpoint. Dealers help promote brand loyalty. Dealers help consumers make their next vehicle decision. If you've had a good experience at the dealer with your new vehicle, you're more likely to rebuy within that brand. If you've had a bad one, then you're likely to shop elsewhere. So the EV world is going to have a dramatic impact on those dealers and where their capital gets put. For the better part of the last 20 years, a lot of the dealer capital would have been put back into the showroom. Now that is going to need to go towards the parts and service, the back office functions, if you will, of a dealer from a vehicle service perspective.
So, over the past year, I've heard you talk a lot about companies permanently reducing costs and accelerating changes as a result of the pandemic. And a lot of the businesses you own obviously benefited. Can you give us an update on those trends and how durable are they?
Sure. So, a year ago, we were coming out of an April and May period where effectively zero vehicles were produced in the U.S. Everything was shut down, and workers were furloughed, factories were shut, and it was a very, very dark and difficult time for an industry that I guess fortunately had already been through the trauma of the General Motors and Chrysler bankruptcies in 2008 and 2009. So there was already some restructuring and some leaning out that had taken place, and they were better prepared to take a great deal of cost out. Unfortunately, most of that was on the human capital side. What happened in the months that followed is that as vehicle production came back online, the types of vehicles being sold were the highest mix, the highest content vehicles that the automakers could make. So very expensive cars and trucks. That allowed them to bring back workers in an appropriate way, where they're generally speaking just about as well staffed as they have been in the past. I think some of the things that have transpired in the interim through stimulus measures have created some labor volatility as it relates to keeping workers, which has been an issue that's been raised on second quarter conference calls. But by and large, a lot of those costs have come back, and unfortunately, with those costs have come the inflationary pressures from raw materials, from logistics issues as it's related to shipments from China, and the overarching issue of the chip shortage that has really impacted light vehicle production for the better part of the last 5 months.
So talking about change in the industry, do you see the pace of financial engineering and M&A activity picking up, which would be a tailwind for the way that Gamco Value invests?
Yeah, I think that we've seen that over the course of the last 5 months, and it's something that I expect will become a dominant investor theme for the course of the next several years. We've got some really interesting dynamics as it relates to new entrants into the industry, whether it is on the electric vehicle side, whether it is active safety, whether it is participants that take place within auto retailing that are attempting to disrupt how cars are bought and sold. And so we've seen financial engineering, first of all, through SPACs within the industry as a way to take public companies in a cost-efficient manner. That's had a major impact within the automotive industry. But we've also seen legacy automotive manufacturers, suppliers, and participants look to acquisition as a way to grow within areas like the electric vehicle space. And what's happened is that you have a number of companies, like Dana, which is out of Maumee, Ohio, that are able to effectively transform who they are in real time, growing within the electric vehicle space, the electric mobility space, while at the same time having their legacy internal combustion engine businesses provide the cash flow to help them grow on the other side. So there's this symbiotic relationship between the internal combustion engine portion and the growing electric vehicle piece, which I think is really exciting. We're seeing it in active safety. We now have somewhat of a bidding war between Magna and Qualcomm for Veoneer, which was spun out of Autoliv a few years ago. The German supplier Hella is allegedly up for sale. So that there's a lot going on within the space from an M&A perspective that's really exciting. And again, you mentioned how we invest, where we're looking at private market value, which is the value that an informed industrialist would pay in an arm's length transaction for a company. And so we see these areas where the puck is going, so to speak, and I think we're well positioned in a number of those areas as we move forward towards this electric future.
And do you think battery technology is really driving companies to look for more M&A opportunities?
Absolutely. I think the battery is the one area that where automakers are looking to derive the most value. One, it's going to be the most expensive portion of the vehicle, and so any time that you can take out costs and improve battery efficiency there, that's going to naturally add to the margin that you're going to be able to get from a vehicle. At the same time, too, from a performance standpoint, if you're really looking to differentiate from an electric car perspective, the amount of miles that you're getting from that battery, the amount of or how fast it takes to charge that battery, those are all factors that are really going to matter to the consumer. As it relates to the suppliers, which is really where we do most of our investment work, they're looking to develop technologies to help those automakers increase vehicle density, increase the amount of power that they're able to get from their batteries, increase the capabilities as it relates to charging those vehicles, keep those batteries cool, battery thermal technology. And I've got a call in 20 minutes with a company that's able to take some of the technology that they've used in heating seats and cooling seats and apply that to thermal technologies for batteries. It's a really exciting time to see these crossover technologies. So it is an area, going back to your original question, where we see the battery as really the focal point of investment for both the suppliers and the automakers alike.
So thinking back pre-pandemic, we did see shares of industrial-related companies challenged by a number of non-COVID-related issues. And this resulted in dislocation between price and what we view as their private market value. An example would be in early 2020, the trade brinksmanship between the U.S. and other nations, most notably China, drove investor uncertainty for supply chains. So what is the state of the supply chain today for U.S. auto industry, and what potential offsets do you see in the future?
Right now, I would call the supply chain fragile. there are a couple of competing factors that are causing serious disruptions on a global level within the auto industry. From a logistics standpoint, shipments from China have been an issue for some time, and the pandemic has only exacerbated that. And for an industry that runs effectively what's known as just-in-time manufacturing, where parts come in the door on one side of the factory and then are moved within an hour into the line, when you combine the logistics issues and the lack of predictability there with the chip issue that has affected predominantly the auto industry, but consumer electronics and a host of other industries, when there's a lack of predictability within an automaker's production board, it causes disruption through the entirety of the tens of thousands of suppliers that provide parts for the auto industry. So it's been a very challenging period, and you have pockets where there's this accordion effect where their plant can have no parts that it needs, no critical parts that it needs, and then a shipment arrives, and so production is sped up, and a bunch of vehicles are made that day, and then they run out. And now the next time, one set of parts comes in, a supplier needs to air freight, their bearings and widgets into that and that air freight costs a fortune. So there's cost pressures put onto the suppliers, and so it's a very fragile time. I think the next obvious question is, when does it end? I would say sometime by the middle of next year, we should have a better handle on chips, and the very costly avenue for the chip industry is to make semi-fab plants in the U.S. so this doesn't quite happen again. But that's again several years from being a reality as it relates to the supply chain. So it's a major issue right now, and the one that most managements are contending with.
So as we move to a greener future, any supply chain risk in today's current climate?
Right now, it's very easy to supply the electric vehicle industry because you're making small baskets of vehicles that are low volume. Anytime you get into thousands of vehicles becoming hundreds of thousands of vehicles becoming millions of vehicles, this will be an unprecedented change, and so I expect there to be what I'd call a non-linear progression to efficiency within production. And by definition, electric vehicle launches are going to be similar to internal combustion engine launches. There are always issues with vehicle launches, and so it's going to be a major challenge for the automakers to have a smooth transition to we'll call it a greener future, but an electric future.
So the infrastructure bill, will this help or hurt the auto industry? Any changes you foresee?
Well, there was a good amount, I believe it was $55 billion for five. Don't quote me on the number because it just happened as I was coming down here, but the amount that was slated for EV infrastructure is incredible, and it's needed because it's a chicken or egg problem as it relates to consumer adoption of vehicles, and something like 50% of U.S. households don't have garages, so charging at home is not something that they're able to do. So fast chargers, DC chargers, AC chargers at areas like grocery stores and restaurants, these are all going to be major issue or major positives as it relates to electric vehicle adoption over the course of the next decade. And that's what we're really talking about here. So the infrastructure bill is a positive. I think you're seeing it in a number of the charging station stocks today, and one that's really needed if we are going to get, as President Biden wants, 8 million vehicles by 2030 sold per year that are EVs.
Mm-hmm. So given everything we've talked about today, a positive long-term view of EV, a robust M&A environment, and transformational trends during the pandemic that could remain durable today, can you share with us some of your favorite stocks?
Sure. Starting in the auto supplier space, I mentioned Dana. Dana is a Maumee, Ohio-based producer of driveline and transmission products, and it is best known for providing every axle of every Jeep Wrangler that has been built since World War II. The company's made a number of acquisitions within the electric vehicle space, predominantly on the commercial truck and off-highway side, and they have a clear path to about $500 million in revenue within the electric vehicle space within the next few years, putting a relatively conservative revenue multiple on what on those electric vehicle revenues get you to about $2 billion in value for a company that's about a $3.3 billion enterprise value. You're basically getting the rest of the business for about 2 times EBITDA, which is very attractive in our view. Outside of Dana, there are areas within, I won't say the electric vehicle space, because it's not just the electric vehicle space, but within the auto retail space, companies like AutoNation, which is the largest dealership group within the U.S. with over 320 dealerships. They are utilizing the cash flow from their core business to grow out their capabilities within what's known as the pre-owned space. So they're called AutoNation USA stores, smaller footprint. Those won't necessarily be just for electric vehicles per se, but the used vehicle market and the transformations taking place within the used vehicle market as consumers change how they purchase vehicles will help drive that transformation that I talked about before, about the cash that's going to be needed to change over the parts and service of their new franchises. And so the positive benefits from this flywheel that they'll generate from these used vehicle stores is going to be considerable. So those are two. It's a really exciting time. There's a lot of change that's taking place. And it's going to be really interesting, Terry, to see what happens to those suppliers that are left with what I'll call a melting ice cube, an internal combustion engine cube, without electric vehicle capabilities, and what that's going to look like 5 or 6 years from now. So, we have our eye on quite a bit, both the new and the legacy.
Well, thank you, Brian. And thank you all for listening to Gabelli Media, and we look forward to you joining us for our next podcast.
Thank you for having me.
Several companies were mentioned in this episode. For the following, we have less than 1%. These include Tesla Inc., TSLA, Ford Motor Company, ticker F, Toyota Motor Corporation, ticker TM, General Motors Company, ticker GM, Chrysler, a Stellantis, STLA subsidiary, Magna International, ticker MGA, Qualcomm, ticker QCOM, Autoliv Incorporated, ticker ALV, Hella GmbH and Company, KGAA, ticker HLE, Jeep, a Stellantis, STLA subsidiary, AutoNation Incorporated, ticker AN, and Veoneer Incorporated, ticker VNE. Additionally, Dana, ticker DAN, was mentioned, for which we own 3.9%. Additionally, one of our affiliates serves as an investment advisor to Dana or affiliated entities and has received compensation within the past 12 months for these non-investment banking securities related services.